Good morning, ladies and gentlemen. The message this week is very simple. We have higher world deficits to finance, and that means that we are in risk off, and also that real rates are going to be higher for longer, simply because we have to finance a much larger world deficit. If Europe is reflating and the US is trying to bring down its budget deficit, and we have absolutely no idea by how much they will succeed or whether they will succeed at all to bring it down, well, that means that for a period of time we have a higher world deficit, and that means that we are in risk off because real rates will be higher for longer. Let's start with Europe, where all the action is. We've switched to a weekly chart because if we have a daily chart, things don't make much sense, but in the weekly time frame, they do. We'll start off with the Schatz, which is the one that's least affected. We had the ECB cut, and also we will still expect one more cut maybe from the ECB this year, and that's going to be it. But you can see that even with a cut, the 2-year could not sustain the lower levels, because what Germany did, and then the EU followed up by loosening up the fiscal brake, basically means that there will be a lot more financing, and there'll be a lot more deficit that needs to be financed throughout Europe. You have to think how the German action actually affects all the states in the EU. While Germany didn't need reflating and rearming, Greece had to go through a period of intense austerity. Italy had to go through the same. And now all of a sudden, when Germany needs it, well, the old rules don't apply anymore. I think that this is the death knell for the European, let's call it solidarity in austerity. It's just not going to happen anymore. Whenever from now on a country gets into trouble and needs to spend its way out of that trouble, they're going to point to Germany, they're going to point to what the EU Commission did, and they're just going to say no. And what can the other member states do? Well, not a lot, because, the hypocrisy is just ridiculous. So from now on, we're going to have higher budget deficits in Europe, that's for sure. And as I've said, that means that the world needs to finance a higher total deficit, and that means that real rates are going to be quite high, or higher than they would have been. Now, think about it this way. What is inflation in Europe? Well, around 2%, right? They are quite convinced they're going to hit the 2% target. Okay, let's give it to them, 2%. And what are real rates in Germany? Still extremely low. Why should the market finance the incredible new deficits that they want to add for rearmament at these ridiculously low levels of real rates? I mean, what is the real rate in the Schatz? 20 basis points. What's the real rate in the Bobble? 50 basis points. What's the real rate in the Bund? 85 basis points. Why would the world finance that at these ridiculously low levels? I don't think they will, and I think that we are headed higher with a much steeper curve in Europe. And if we look at where the levels are, I think that over time the Schatz is going to go to at least the 250 area, 244, 245, something like that. Don't forget, this is a weekly chart, so it allows for weekly moves. If we bring it down to a daily level, certainly this 200-day moving average at 235 at some stage gets challenged, and then over time we will turn it and go higher. Let's have a look at the fives. To me, the fives, every time they dip now to around the 245 level, you are supposed to be buying puts on the bubble, i.e. calls on the rates. And I think that certainly these higher levels around the 270 area, which was the highs here in May and June of last year, are going to be challenged at some stage. The tens have gone the most because they should go the most. Buying duration in Europe here, to me, is just suicide. This move is not enough. And let's take it, back to a monthly move. And we are going to break out of these monthly levels over time. And I have absolutely, so no compunction in believing that we will hit the 365. 365 makes sense simply because if inflation is at 2, that is 165 real, right? And there I think you can finance the new deficits. But, at 85 real, why would you bother? It just makes no sense to me that is where you finance the European deficits. Look at this chart, look at what happened in 1994, look what happened on reunification. We always go at least 300 basis points. We add real steepness to the curve and add to the real rate. And I have absolutely no doubt that over time we're going up towards 365, if not up to these levels, which are around the 460 area. So I just don't see any point in thinking of buying the dip in bunds for the time being. This is another weekly chart of the yield curve. This is 2s, 10s, and you can see that we are still at levels which are not normal. Where is the normal level of 2s, 10s when you have to fund a big deficit? Well, it's much closer to this 180 level, 160 to 180. This is still too cheap. And I think the yield curve is just going to steepen and steepen and steepen. 88 is the first level, and after that 120, and after that 180. There is absolutely no reason to be long of duration in Germany at the moment. If we have a look at something like the 5s, 30s, where is the normal level? Well, I would have thought that we need to get to this area first, i.e. 93 to 70, before we go lower. It just doesn't make any sense to be a buyer of duration in Germany until we get to these levels, 150. So it just doesn't make any sense to be long of duration in Germany. And if it doesn't make any sense to be long of duration in Germany, it doesn't really make much sense to be long of it or to extend duration in the US. Because the US is going to trade on a spread. The spread might come in, but it's not going to come in 200 basis points straight away, which basically means that with all the budget deficits that the US has and the competition for funds for funding this deficit, I just can't see how the US can improve very much. And we'll look at the differentials now, and we'll also look at the outrights in the US. So let's have a look at a long-term chart of the differentials between the US and Germany. This is 2s on a weekly basis, which you can see up here. And these levels are still very elevated, right? Where have differentials been in a period where the US is suffering from less growth or a growth scare or whatever you might want to call it, and Europe is trying to reflate? Well, you can see that that spread can easily go to this area, which is between 100 and 35. So we are still 100 basis points too high, and this is twos. If we have a look at something more indicative like tens, you can see that we can easily go down to this 105 level or even to 85. That to me would not be ridiculous at all. This has been a major fundamental move, and if we take it down to a 1 day, you can see how major and fundamental it was. You can forget about the technicals when something like this happens. We are definitely turning the 200-day moving average. I think any bounce is a great opportunity to get short of Germany, simply because I don't think the US can rally at all. So doing long US, short Germany, yes, that does reduce your risk, but also the likelihood that you're going to make any money on the US side is almost zero to me. So I much prefer just to do outright short Germany. And I think that that spread will definitely go down to this area here between 120 and 105 in quite short order. I wouldn't have thought it's going to take much more than another, I don't know, month or so. So if we have returned to the weekly chart, this area here to me is the first area that you can hope for some support for the spread, and after that we see. But if we go back in time, you can see that quite easily you could go down to 50 basis points in that spread. And I think that that is what the Trump administration is actually shooting for, that they are trying to bring down the 10-year note through reductions in the deficit, through decent real growth, which again reduces the budget deficit, while Europe is abandoning the restrictions to the budget deficits that were self-imposed, and now they're going gangbusters the other way and increasing them. Well, for a reasonable period of time, that means that real rates have to be higher at the long end, simply because there is more competition to fund world deficits. The total world deficit is going up. However much the US might try to bring theirs down, it's not going to be nearly enough to cancel what Europe is trying to put on. So overall, the world deficit is going higher, and therefore real rates can only go higher or stay higher for longer. Let's have a look at what the US did, and I'm still on weekly charts because I think you have to be on weekly charts. When something fundamental happens like what happened last week, you have to zoom out a little bit. So the twos basically did nothing. They closed maybe 1 or 2 basis points higher. The fives closed a little bit higher than the twos. The tens closed even a little bit higher than the fives, and the 30s closed higher the most, i.e. the yield curve is steepening. And that is the natural response. Why did so little happen in the US last week? Because people were buying the US and selling Europe. This might last for, a while yet, but all these charts, whether it be twos all the way out to 30s, with these Bollinger Bands which are contracting on the weeklies, tell you that there's very little downside to the US market. So what I expect the US to do is to just trade sideways. I think there's very little pressure for it to go down. Now, this week we have CPI and PPI, and they could change the picture, but I think it's low odds. I think the higher probability is that CPI comes in line and that the US just can't do any better. So where do I expect fives to go? I expect them to go back towards Fed funds and general collateral, higher than 425, around the 435 area. I just don't see why you would want to buy fives and tens below general collateral unless there is an imminent move for lower real rates and the Fed cutting. Well, I don't think that that is going to happen for quite a while now. We had Waller out, we had Powell out, and they both said that they're very happy. And they have no reason to do anything but wait. Now, I think that that is precisely what they're going to do. I think March is way off the table. And then you just wait to see what the data shows you. If the data shows you profound economic weakness in the US and lower inflation, then yes, then what's going to happen is that you might see lower US rates, and that's going to dampen down how far bonds go. But I think that spread between the tens in the US and the bonds keeps on going, i.e. you're going to have days when the US does really well and the bonds do nothing. And that is how the spread widens. So the only question to me is, how does the spread widen? Does it widen because US rates come down and the bonds do nothing? Or does it widen because bond rates go up and the US does not a lot? I think it's more likely, until we get data, that the US does not a lot and bond rates go higher. Let's have a look at term premia and also real rates in the US to give us a better idea and triangulate what I've been saying so far. Now, term premia has come down quite a bit since the Trump administration took over, and that is reflective of the hopes that Doge is going to be able to significantly reduce the US budget deficit. I think the odds are low, but let's give them the benefit of the doubt. Now, do we think that these term premia really start moving in a lot more with the world competition for funding deficits? I think that is unlikely. I think, if anything, they stay in this range. And therefore, if they stay in this range, you're talking about a US bond which goes nowhere, and the only way that spread to Germany can move is by the bonds going higher in yield. Now let's have a look at real rates. Real rates also have come down with the term premium, but now where are they? I mean, the week before that 180, this week they are actually up at 195, reflecting the increase in total world budget deficit financing needs. I think it's unrealistic to expect these yields, which have basically ranged for the best part of 2 years between 255 and 150, to start breaking down and taking out the lows. To me, that is unrealistic at this point of time. What does that tell me? That tells me that really real rates could easily stay between a 180 to 225 range for a bit. And what does that tell you? That tells you that you're talking about plus 20, minus 20, plus 20, minus 20 constantly in the 10-year note, i.e. overall it going nowhere. And then the only way that I can see that the European budget deficit gets financed is if there are higher rates, real rates in Europe. And that necessarily means much higher bond rates. Naturally, foreign exchange had to readjust after that fundamental move, and by the Germans, and we are talking about now, as a result of the differentials, going probably all the way up towards this 110.65 at some stage. If we look at the weekly chart, all we did is basically in one fell swoop we went to the top of the Bollinger Bands and the 200 weekly MA. Now, is there a possibility that we have some sort of a small retrace? There's always that possibility, but I think it's going to be limited to something like 106.70, 106.50 maximum. And there you're supposed to buy it again, because I'm quite convinced that we are going to go up and test the 109.90 to 110 110.70 area. This makes perfect sense to me that we will go higher at some stage. What this chart does suggest is that we have the possibility next week of slightly lower levels in the Euro USD, which would mean that that differential between the Bund and the 10-year note actually comes in a little bit, and that should be our opportunity. I think any chance that you get to do bunds against 10-year notes, i.e. short bunds, you should take, at least in the options. So if we do come down to 106.60, 106.50, I think the odds are overwhelming that you are supposed to buy it. Longer term, it's going back up towards 110. I'm absolutely convinced. If we look at a chart of Dixie, I think the support levels are quite clear. The first one is going to be around the 102 area. Whether it's 102.82 or 102 per se, I mean, who cares? But it's going to be somewhere in the 102s. And finally, the big support and where the market should trend towards over the course of the next weeks is parity. I think the Trump administration will be quite happy to see parity again. You can see that the market is quite happy at parity. Below it, it's difficult, but parity for sure, the market will trade sometime this year, I'm convinced. Gold in US dollar terms did very little last week, but actually gold in euro terms did quite a bit. Where is its support? Well, it's going to be somewhere around here, 25.50 area in euro USD. And if you say 110, that offers another 200 higher in euro in gold USD. So if we go back to gold USD, that gives us this kind of level, 27.50-ish. I think the market is going to swoon towards there. Why? Because gold Euro USD is coming down. And why is it coming down? Because real European rates are going up. And there is less reason for people to fear a devaluation of their euros, and therefore less reason for them to buy gold. So I think Euro USD is going to, or rather gold Euro USD is going to lead gold in dollars lower as well. Not a lot, but it should come down. And that is the only thing that makes sense and triangulates with the higher real rates in Europe. Commodities as a whole are doing much of nothing, and they failed at the upper levels. They've come back down to the 200-day. I think if you see a dip in commodities, you are supposed to buy it. I'm not sure why, because it doesn't really make much sense, but I think that anything in this area, 2120 to 2070, is a buy, and at some stage we see it back up to 2293. I think the fact that Europe is reflating should be positive for commodities, and certainly should stabilize the GLD-GSG spread. I am not so bullish on it anymore. I think it's got probably room to come back down and test lower levels. I don't think the trend is turning, but I think it's probably overextended at the moment. So I would prefer GSG on a dip, simply because it's done nothing for years and years and years and years. And if you have a look actually at a weekly chart, you know, this is getting very long in the tooth, staying in this range. And the fact that there's a rising 200-day moving average tells me that, you know, these 20 levels, 21 and something, are going to be very good support. And I'd really rather want to give it a go from the long side here at around 2080, 2100. it makes perfect sense with reflation and the fact that there is a finite amount of commodities. I know that they want oil down, and they've got oil down. Oil is down to the 60. Do they really want it much lower? No, because how are they going to achieve that 3 million barrels target, the 333 that Besant has? With the price of oil in the low 60s or lower, nobody in the US is going to want to increase production. So they can't get oil much lower, and oil can't be much more of a help to inflation. It can go another 5% or so, yeah, no problem at all. But when you start talking about double digit lower in oil, i.e. another more than $6, it's a problem. So that's why I think that this area in GSG is going to be a decent place to buy some and see if we can break later on in the year this 23 level. Let's start with the clean chart, and absolutely beautiful touch of 56, 68 and straight up. And we finished the week much lower than we started it, but basically we finished it in no man's land at this 57.62 area, which is support. I still expect this market to range. I think 58.65 should be somewhere near the top, and I would love to see a gap fill here at 56.17 at some stage. That to me is the natural place that we stop until the data tells us that we really are in a slowdown. But now that Europe is reflating, how much of a slowdown can we have? I think the probabilities that we get a recession in the US have probably gone down last week, not up. And therefore, I think that equities are really a trading range at a lower trading level rather than a complete sort of sell everything. Let's have a look at what the risk indicators are saying and what levels they're at and where support might be. Weekly chart of ITOT over government, and you can see that yes, we have turned, yes, we're in a bear phase, but I think it's, we need time to go by, and that's why I'm not immediately bearish of equities. I think a range trade is far more likely than a dump, an outright dump. We have CPI, we have PPI, those should really not be surprises for us, and therefore I think the probability is for more sideways rather than a straight dump in equities. NQ actually traded very well technically last week. This 19,900 level was never threatened on a closing basis on the 195-minute chart. And that to me says that we are in one of these periods, right? Where we are going to be trading between here and there, which is 20,600. What would I love to see? Just like I would love to see that gap close in the SPX, I would love to see 19,330 and gap close. But I think that we are more likely to spend a few days going sideways. So that's my message for equities in general, seems to be sideways. If one thinks about it logically, the one market that should start performing in the next few weeks and months is actually EEM. If the dollar is going to remain weak, that makes the countries and companies that borrow in dollars and have to return fewer dollars better, i.e., all these emerging market countries where all their indebtedness is in dollars should start seeing their dollar bonds trade better, i.e. at a narrower spread towards the USDs, and also their equity markets do slightly better because those spreads are coming in. It's not visible here, right? And absolutely not visible. So what I am thinking of doing for myself is selling puts struck at 42.32, as close as possible, 42 and a quarter, whatever, because if EEM comes down, I probably want to get long. It makes sense to me against all the other equity markets. It's by far the cheapest, right? It's been in this range since God was a boy. And it's about time that if the US markets are in a sideways phase and basically they're dead money for a while, that they're not going to make new highs, well, where'd you put your money? There's far more probability that EEM starts performing with the weaker dollar than not. So it's just a bit of a punt with a little bit of money to sell these 42 and a quarter puts for 3 months and see what happens. The one market which is not triangulating with my sideways price action thesis in equities is volatility. Volatility closed above 2280 at 2340, and it's a warning sign. It's definitely a warning sign that something could be brewing, because it doesn't do this very often, close above 2280. As you can see, it's right at the top of the Bollinger Bands on the weekly, and it's far through it on the dailies. I think that is going to be okay. It's going to come down a little bit, but longer term, it's a bit of a warning sign that not everything is all right with equities. I'm going to be watching this very hard next week, because it could negate my thesis about sideways completely. I've updated all the levels, and really all I want to do is look for levels to short bunds against everything. Again, I covered at the right level, and I just want to get opportunities to resell them, and against everything, against the German curve, against the US curve, against everything. I think that is by far the highest probability trade. And if Dixie comes back down towards, that 105 level, which equates to around the 106.70.80 in Euro USD, which is really the same trade as selling bunds. So that is what I'm looking for. I don't think there's anything else as fundamental as what is happening in Germany and their rates, and that it should continue for a long time. Thank you very much indeed, and tweet you tomorrow.